The Fed chair just told the world he has no idea which direction rates are going next, and the reason is a war. Jerome Powell, speaking at Harvard today, said the economic effects of the Iran conflict are so uncertain that rates could move higher or lower from here. That is not a dovish pivot. That is not a hawkish hold. That is the most powerful central banker on earth telling you he is flying blind. And if you are not paying attention to what that means for your money, you are already behind. Welcome to Daily Market Breakdown. I'm glad you're here because today we are dissecting Powell's critical comments on the Iran war, the oil shock, and the two-way rate risk that just got injected into every asset class. By the end of this video, you will understand exactly how to read this uncertainty, protect your downside, and spot the opportunities that volatility always creates. All right, let's get into the facts. Fed Chair Jerome Powell spoke at Harvard University today and delivered what I would call a masterclass in strategic ambiguity. Here is what he actually said. First, he acknowledged that the Iran war creates risks to the economy that could push rates in either direction. Direct quote context from MarketWatch, Powell said the Fed is not facing an imminent decision on what to do with rates because, quote, we do not know what the economic effects of the Iran war will be. Now, separately, CNBC reported that Powell sees the inflation outlook as in check and sees no need to hike rates specifically because of the oil shock. That is a critical nuance, folks. He is separating the oil price spike from the broader inflation picture. He is essentially saying, yes, oil is elevated, yes, there is geopolitical chaos, but we are not going to panic hike into a war. At the same time, he is not cutting either. He is keeping both doors wide open. Meanwhile, high-yield savings accounts are still offering up to 4% APY, and money market accounts are at 4.01%. That tells you the rate environment remains elevated. Cash is still earning real yield, which means the Fed has not moved meaningfully in either direction yet. Now, let me break down what this actually means because the headlines do not tell you the full story. Think of the Fed right now like a driver approaching a fork in the road in dense fog. They can see maybe 10 feet ahead. They know the road splits. One path leads to rate cuts if the economy weakens from war disruption, supply chain damage, and consumer pullback. The other path leads to rate hikes if oil prices stay elevated long enough to reignite sticky inflation. But Powell is telling you, I cannot see which road we are on yet, so I am slowing down and keeping my hands on the wheel. That is what strategic patience looks like. Now, here is the second analogy that really matters. Imagine you are a homeowner and there is a massive storm heading toward your neighborhood. You do not know if it is going to be a Category 1 or a Category 5. What do? You do not tear down your house and rebuild. You board up the windows, you stock supplies, and you wait for more data. That is exactly what Powell is doing with monetary policy. He is boarding up the windows. He is not making a move until the storm's path becomes clearer. For investors, this creates a very specific environment. Two-way rate risk means bond markets could whipsaw. It means growth stocks face uncertainty on the discount rate. It means energy stocks have a geopolitical bid underneath them, but also face demand destruction risk if the war escalates and the economy slows. The key variable to watch is oil. If crude stays elevated but contained, say in the $80 to $95 range, Powell can afford to wait. If oil spikes above 100 and stays there, the inflation calculus changes fast, and if the war de-escalates and oil drops, the door to rate cuts swings wide open. This is a data-dependent Fed in the truest sense of the word, and the data they are waiting for is not just economic, it is geopolitical. Now, let's talk about two names that every single one of you is watching, Tesla and NVDA. I want to be transparent. Today's data feed did not include specific price action or earnings data for TSLA or NVDA. But here is what we can infer from the macro setup. Tesla is a company that is highly sensitive to consumer discretionary spending and interest rates. If Powell's two-way risk resolves toward cuts, that is a tailwind for Tesla's auto financing costs and consumer demand. If it resolves toward hikes because of persistent oil-driven inflation, that is a headwind. Tesla also has exposure to energy markets through its solar and battery business, which could benefit from elevated oil prices driving alternative energy demand. NVIDIA, on the other hand, is less directly exposed to oil but extremely sensitive to the rate environment through its growth stock valuation. The AI spending cycle remains the dominant narrative for NVIDIA. But if rates move higher unexpectedly, the multiple compression risk is real. Both names are essentially hostage to the same macro question Powell raised today: which direction are rates going? Until that resolves, expect elevated volatility in both. All right, here is my personal take. My bull-bear score today is 5 out of 10, dead neutral and intentionally so. Here is why. The base case, which I would assign about a 55% probability, is that Powell holds rates steady through at least the summer, oil remains elevated but manageable, and the market grinds sideways with sector rotation favoring energy and defensives. The risk scenario, maybe 30% probability, is that the Iran conflict escalates significantly, oil spikes above $100, and the Fed is forced into a hawkish posture that crushes growth stocks and tips the economy toward recession. The upside scenario, about 15%, is a diplomatic resolution that sends oil lower, clears the path for rate cuts, and sparks a broad risk-on rally. In this environment, my positioning framework is simple. Reduce concentration risk, hold some cash, which is earning 4% anyway, and do not try to be a hero. If you are new to managing a portfolio in volatile environments like this, I would genuinely recommend practicing with paper trading before putting real capital at risk. Webull has a solid paper trading feature. The link is in the description if you want to check it out. No pressure, but it is a great way to test your thesis without losing sleep. So here is the bottom line. Powell just told the market that uncertainty is the only certainty right now. Rates could go up, rates could go down. The Iran war is the wild card that nobody can model. Your job as an investor is not to predict the unpredictable. It is to build a portfolio that survives both scenarios. If you found this breakdown useful, hit that subscribe button so you do not miss tomorrow's update. The core message today: manage your risk first, chase returns second. Stay informed and stay profitable. I will catch you in the next one.